There's a huge mystery hiding in plain sight in today's stock market. Something has fundamentally changed about how wealth is created. And honestly, most people haven't even noticed. Just think about Amazon for a second. It went public when it was basically just an online bookstore, a tiny little company. Early investors, they got to ride that rocket ship all the way up. That was the dream of the public market. But that dream, well, it feels like it's fading fast.
So we've got to ask the big question right up front. Are you, the regular investor, being systematically locked out of the biggest growth stories of our time? I mean, is the game now rigged before you even get a chance to play? In this explainer, we're going to follow the money and find out exactly what's going on.
All right, to get what's happening, we need to go to the scene of the crime, the initial public offering, the IPO. This used to be a company's big debut, its coming out party on the world stage. But the nature of that party has completely changed. Back in the day, it was pretty simple. You had the classic IPO, a young, scrappy company, high risk for sure, but with the potential for those insane 100x returns. Public investors got to be part of that whole journey. But now we have the modern IPO. A company waits until it's already a massive, mature giant. All that explosive growth? Yeah, that's already happened. But it happened behind closed doors. You're just getting invited in at the very end, right at the top.
And that's the whole thing, right? An IPO went from being a graduation to a burden. It's something companies are now actively trying to avoid for as long as they possibly can. So the question is, why? What happened? What made being a public company so miserable? The reason is something we're calling the Public Market Gauntlet. And this isn't some single villain in a suit. No, it's a whole system of intense pressure, crazy scrutiny, and just crushing costs that's made the public markets a really unattractive place for a growing company to be.
And this quote from PwC just lays it out perfectly. Going public is monumental. Yeah, it opens the door to huge amounts of capital, but it comes at a massive cost. You are permanently under the microscope. It's a deal with the devil that a lot of CEOs are just not willing to make anymore. And that cost isn't just some abstract idea. I mean, what does it actually cost to exist in this gauntlet? Well, according to a big study from researchers at Drexel's Liebau College of Business, the total compliance cost for a typical U.S. public company is a staggering 4.1% of its entire market value. Let's just put that in perspective for a second. That is not a one-time fee. It's like an ongoing tax you pay every single year, just for the privilege of being public. It's the price of climbing a literal mountain of expensive paperwork and getting through a maze of complex rules over and over again. So what does life on this treadmill actually look like for a CEO? Well, it is relentless. You are chained to quarterly earnings reports, which forces you to think in 90-day sprints instead of, 10-year visions. You're buried under super expensive compliance rules like Sarbanes-Oxley, and you're constantly being second-guessed by this army of analysts and investors who can absolutely tank your stock with just one bad report. It is a pressure cooker. It's honestly exhausting just talking about it. So it's no surprise that founders and CEOs started asking a pretty simple question. What if there was another way? What if we could get all the money we need to grow, but without all of this public misery? And that very question led them straight to an unlikely savior, a force that has completely reshaped the entire financial world, the private equity haven. So what in the world is private equity, or PE? Well, simply put, these are firms that raise gigantic pools of money, and I'm talking billions and billions of dollars from big investors. They use that cash to buy or invest in promising companies, and they keep them private. But they don't just write a check and walk away. Nope. They actually offer their expertise to help these companies grow, all without the harsh glare of the public markets. Think of it like this. If the public market is a cold, raging storm, private equity is like a warm, private blanket. It shields these companies from the howling winds of quarterly earnings and the downpour of regulations. It lets them focus on what actually matters, building a great business for the long haul. So this is the choice a CEO faces today. On one side, you've got the stormy public market, with its constant scrutiny and relentless demand for short-term results. On the other, you have the sheltered private market, which is all about flexibility and long-term growth. I mean, which world would you choose to build your company in? For more and more founders, the answer is, well, it's pretty obvious. So, the companies get what they want. They get the money they need and the protection they crave. It sounds like a perfect solution, doesn't it?
Well, it's a perfect solution for them. But the story doesn't stop there, because this massive shift has huge consequences for you, the retail investor. And that brings us to the final and most crucial part of our story: investing in the aftermath. What does this new landscape really mean for your wallet and your financial future?
And look, this isn't just a theory, we've got hard data. According to Vanguard's 2025 Market Outlook, the 10-year forecast for public stocks is about a 5.4% annual return. For private equity, 8.9%. That is a massive performance gap. That difference, compounded over a decade, that's the opportunity you're missing out on by being locked out of these private deals.
So who actually gets to capture that explosive 100x growth that used to happen out in the open? Well, the vast majority of it, a lion's share, now goes to private investors, the PE firms, the venture capitalists, the founders. By the time that company finally decides to have its IPO, public investors are left fighting over the scraps.
And here's the bottom line. The public is still getting invited to the party, but the invitation shows up long after the champagne's been popped and the cake has been eaten. You're not buying into the next big thing anymore. You're just buying the leftovers.
And all of this leaves us with a final, pretty sobering question to think about. As all the best, most innovative companies stay private longer, fed by trillions of dollars in private equity, we have to ask, is the stock market's golden age of opportunity really and truly over for the average person?